Ladies and gentlemen, we're about to begin our presentation. Please direct your attention to the podium.
Good afternoon, everyone. Good afternoon. Good afternoon from the Marriott Eaton Centre in downtown Toronto. Welcome to the Empire Club. For those of you joining us either by webcast or podcast, welcome to the meeting. Today we have two distinguished professionals who will be joining each other on stage to discuss Canada, the global real estate landscape, the global economy, and what we can expect in the future. I am certain that real estate has supplanted hockey and weather as topics that Canadians most like to discuss. It's hotly debated at all three levels of government, and we heard it as a feature in the recent federal election. But these two gentlemen are here to talk about more than whether you should reno the semi in Leaside. Their expertise goes well beyond that. I am pleased to have them here to share their expertise with you today. Bruce Flatt is the CEO of Brookfield Asset Management, where he supervises more than $500 billion in assets under management. Brookfield is active in more than 30 countries around the world. Before becoming CEO in 2002, Bruce ran Brookfield's real estate and investment operations. He was named one of the top 100 best performing CEOs by the Harvard Business Review, and the New York Times called him no less than the Warren Buffett of Canada. Blake, who's always been Blake, Hutcheson, currently serves as the President and Chief Pension Officer of OMERS, one of Canada's largest defined benefit pension plans. Prior to this role, he held key leadership positions with Oxford Property Group, Mount Kellett Capital Management, and CB Richard Ellis. He is a former recipient of Canada's Top 40 Under 40 and has spent the majority of his career navigating Canada's complicated real estate industry. We are lucky to have him here to share his expertise today. So there's no one better to there's really no one better to take us through this topic, real estate and the global economy, than Bruce and Blake. So without further ado, please join me in welcoming Bruce Flatt and Bruce Hutcheson to the stage.
That's twice. So, good afternoon, everybody. Bruce and I went out last night for dinner and went to the basketball game, and we both reflected on what an honor it is to be here at this esteemed and established club. And we had one lamentation only, and that was, who the hell would invite us to a Cadillac Fairview building to speak about the real estate business? So, I will forgive you for calling me Bruce twice. In this company, trust me, it's a compliment. The Cadillac stuff, I'm not so sure. Okay, so here's the drill. First of all, not every day we get an opportunity to hear from Bruce. My dear friend Antoinette Tamilo called me, said we have an event. Any chance you could get Bruce here before Christmas? I said he lives 40% of the time in London, 40% of the time in New York, probably the busiest CEO I know globally. I doubt it, but I'll give it a shot for you. I put a call into Bruce. He said, give me 24 hours. He called me back. He said, I'd love to get back to Canada. I'd love to talk to you guys. So rare occasion for him to do it. Big honor that you would do it. On behalf of all of us, thank you, and thank you personally. I know I owe you one. And the format of today, we've sort of got 45 minutes. The format of today is, I've been in the service industry my whole life, and I know that you can hear from me another time. We don't get this guy often. So I'm going to pepper him with questions. This is his day. I'll ask him the questions. He'll get I know, some terrific answers. I'm going to cover a little bit of his personal life, very little, I promise. A lot about Brookfield. Very little. A lot about Brookfield, a lot about the global economy, certainly some real estate, but it's not just about real estate. And we'll end with some concluding remarks. I have given him some softball questions in advance. I will surprise him with a few others. I have no idea what he's going to say, but I have a feeling you're all in for a treat. And with that background, you grew up in Winnipeg, you got educated in Winnipeg, you are now CEO of, without any question, one of the greatest global success stories. The odds of that are improbable. And so, what the hell happened? Tell us the story. Yeah.
So, look, firstly, thanks for being here. It's a thrill to be here. I know many of you, some I said hello to, for others that I didn't say hello to, hello. But in addition to that, thanks to everyone that came out. It's a great honor. And look, I would just say the following. We at Brookfield got really lucky. And I just say it comes down to just two simple things. Interest rates were 8%, and they've essentially gone to zero globally. I'll use zero just as a number. And institutional money, which you should comment on, Blake, institutional money in the world was large, and it's gone to very large, and it's getting even bigger. And with interest rates at zero and with large pools of money that have to be invested to earn a return, somebody has to put that money to work to earn more than zero in a treasury bill. And I say we got lucky. We happen to be in that system, and I would put it down to two individuals at our organization. The one that really came up with the idea was George Myhall. Some of you may know George. I don't think he's here. George, are you here? George is not here. But George came up with the idea 25 years ago that we should offer these products to institutions. And you guys were into it in real estate a little bit, but not many were. Yeah. And that's really the whole success, is just getting in the way. And yeah, we executed okay along the way. Yeah, I'll say. Made our share of mistakes, but we didn't make any unduly large mistakes during that 25 years.
Did you notice how he pivoted away from the personal? That was exquisite, Bruce. So you were the CEO of the property business at 29. You were the CEO of what's known as BAM, Brookfield Asset Management, at 36. Today we get used to young CEOs. Gates was CEO of his organization at 20. Mark Zuckerberg, CEO of his corporation at 20. But particularly 17, 20 years ago, particularly with corporations, you don't set up, you inherit, and you pick up and grow. There were no 36-year-old CEOs. And you think about Bob McNamara was CEO of Ford at 44. Kennedy was president at 43. Those are two examples. Gordie Nixon was president of Royal Bank at 44. Very few at 36. And so reflect on that early opportunity to lead, and kind of what was the size of the business then versus the size of the business now, but particularly an early minted opportunity is seldom put in someone's lap. So talk to us.
Yeah, look, I would just say firstly that Brookfield then was not what Brookfield is today. So it was a much smaller organization, but it was still sizable, and we controlled a lot of things. So it was a great privilege to be put in charge of a bunch of partners. And I would just say it, again, we as a group, I happen to be the leader, but there was a lot of us that did everything we did within the organization. And I'd say the biggest thing that's left on us as individuals is that we constantly spend our time trying to think about how we build out the organization and what we're doing about the next generations of people in the company. Yeah. Because if we can, sometimes companies are successful for 10 years, 20, 15 years, 20 years, 25. Very few last 50, 75 years. Yeah. If we can accomplish long durations by very successful planning of people, then you can create great long-term companies. And really, I guess that's we spend a lot of time on that, but as we and even myself, get older, we need to think about that and make sure that we do the same thing that we did at that point in time. And look, the fact is, people that are 60 years old don't work as hard or can't get up in the morning as early as somebody that's 35. So it's a great benefit to organizations to bring along younger people. That's not against the 60-year-olds that are here. Blake and I are with you.
Yeah,
but the point is, if you can bring those people along, and we happen to run our company where we have the opportunity to give people great breadth of accountability for businesses, regions, parts of the world, P&Ls, and that's the difference that we have compared to many organizations, because we have all these separate P&Ls, and therefore people can get accountability, which they wouldn't otherwise get in most companies.
And I think many of you know Bruce was named CEO of the Year for the Globe and Mail in 2017, but he said, which is a classic Bruce, he said, no, I'm not taking it. I'll take it with my 4 colleagues. 5 of us are all worthy. If you want to honor one, that's not me. If you want to honor all 5, that is me. Extraordinary gesture, probably the first time and maybe the last that'll happen. To give you an idea of size, so Brookfield Asset Management today is 500 billion of assets under management. So CPPIB, Canada's biggest pension plan, 400 billion. When you think of profitability, you have 500 billion of assets under management. A fair year for Bruce is 10%, call it, $50 billion in profits. Canada's largest bank last year produced 12.4 billion in profits. So we're talking about an enterprise that's significantly larger than Canada's largest pension plan, significantly more profitable than, frankly, all of our banks combined. That's the order of magnitude for the organization. But it's not all about size. And at what point, I know I like to know our people. When I jump in an airplane, I like to know them. I like to know our partners. And as you scale organizations, you lose the personal touch, or you can. So how big is too big? What's the sweet spot? You know, BlackRock's $7 trillion. That's a different model altogether. But talk to us about size.
Yeah, so here's what I'd say. We decided years ago that to be our little niche in the business, and everyone's different, but we decided that if we could develop 3 things, it would give us a competitive advantage. So everything that we do derives around those 3 things, and the 3 are scale, the ability to be global and move capital around the world, and operating capabilities within the franchise. And by virtue of those, we think our capital is differentiated. There's no doubt, by being in 30 countries, by having 150,000 employees, by having 2,000 investment people, by raising, this year we raised $50 billion of capital, there's no doubt you lose something. I'm sure in any one jurisdiction, we will not do as well as the local group. But what we advantage ourselves with is that we have access to more capital than most people in the world. Yeah. We can move our money to countries when capital is not available. Secondly, and third, we can, with our operating people, we can work, develop, do things with the businesses. And what I'd say is, yes, we lose something on the first part, but we think we get more out of these 3 advantages by having that scale, et cetera. And so I'd acknowledge that, but we try hard. We try hard to be out there, and we myself and others and senior in the company spend a lot of time around the world and in our different operations and meeting our people and trying to be close to them. It's not easy, but trying.
So hear that number, $50 billion a year they raised this year. And it wasn't so long ago that Goldman Sachs through Whitehall was in the business in a big way. Morgan Stanley through Meserif was in a big way. Lehman Brothers were a serious player. There was a collective of 10 or 12 powerhouses. There's been a lot of attrition through the collapse of the economy 7 or 8 years ago. And there's also been a movement by big funds to aggregate to very few players who they like and trust. So how much of your life and the size you've amassed and the place you've arrived as really a handful of players in the world is through attrition, and part of life is showing up, and how much of it is actually recognizing that over time there will be a consolidation and you had to scale to get into that zone?
You know, the thing you forgot is that in that period of time, players like yourself, and I'd say the Canadian pension plans, which you may want to just reflect on the size of those, they have developed the same, they've replaced some of those people that were out there. Like, I don't know how big your infrastructure and real estate business was 10 years ago, but it's a lot bigger today, and it's much more active and much more, larger.
So we're 110 billion today of our own equity. We're going to 200 billion in the next 8 years. With leverage, with partners, it won't be long before we're on your tail. We'll take a while, but it'll take a while. But the complexity of our organization too, we've got 500,000 pensioners. We're dealing with 1,000 municipalities. We're dealing with 40 associations and unions. We have 3,200 employees, but we have 24,000 with our investor companies. There's 200 countries in the world. We're investing in 50 of them, and we're operating a global company today out of 20 offices in 12 time zones. So
My job sounds simple.
no, it doesn't. And we're a fraction of your size. And 10 years ago, we were primarily domestic funds. So you're right. There's been an emergence of serious players, and I hope people can appreciate, in a global context, the way the pension plan system has been set up in Canada. It really does outpunch its weight class, and it is giving the world a run for their money. But still, Brookfield and a handful of others are in a league of their own and have remained that way. And part of that is, as some disappear, it's the many-headed snakes, many do appear. Talk about performance. We've seen funds melt down with one bad attribution year. It doesn't take long before one fund doesn't make it, and it's hard to raise money for the next one. You have consistently outperformed. For fun, I called Jack Ockwell, who was his predecessor, and I said, Jack, what do you want me to say? And he said, well, first of all, we didn't pick Bruce at 36. We picked him at 33. And then he decided to wait for 3 years while we trained him a bit, but he didn't need it. He said there were 6 of us that made the decision. We knew at 33 what he would do for us. He said, absolutely amazing mind, amazing business person, focused, and he's outperformed, honestly, Blake, he's outperformed for us 17 years straight. So there's a story, and while your stock hovered for 3 or 4 years, this year alone, the stock's up 57%. So tell us how you can consistently impress Jack and consistently outperform.
So look, I would say the only comment I'd make on investing is we've always tried to ensure that there's nothing that we ever do that will irreparably harm any business, investment fund, company, or track record. Which means that we may not get the outsized performance sometimes, but what it means is that nothing will ever
no single
damage.
deal is more than 20% of a fund.
All of those things, and it really is, because you constantly make mistakes, and as you learn from your mistakes, you get better. And the amount of mistakes we've made over the years, it's ridiculous.
Share one with us.
But what I was going to say.
He asked for it. He asked for it. Yeah.
If you keep learning from those mistakes and they don't harm you, and the biggest thing isn't the returns, and you'll understand when I say this. It's not even that it affects your track record. It's that you blow the confidence of your team, your people, your board, and your clients. And when you make big mistakes, it just destroys the franchise. Look, I grew up, and what happened in Canada was most corporations went to the United States, they made one big acquisition, and they blew their feet off, and then the board said to them, no more. And it was a terrible destruction of corporate Confidence, yes. And so what we've tried to do is just be incremental all the time. And therefore, we've just kept at it. And the greatest thing in investing is just keep compounding, whether it's knowledge, experience, lack of mistakes, little mistakes. And we've just do that. So I would say, look, the greatest thing that happened for us, other than the two things I mentioned up front, is that prior to 2008, we didn't do anything that was really stupid. Therefore, we had the confidence of the financial markets, the banks, and other people during the financial crisis. People allowed us to have further capital. We kept investing, and we came out the other side.
Yeah.
Most people did something really stupid in 2005, 6, and 7, which irreparably harmed the franchise, and they never came out the other side. And there's only two that didn't, leave aside pension organizations or sovereign plans, institutions. There's only two investment organizations, Blackstone and us, that survived that, the last financial crisis. And we were I'm just going to use round things, we were number 9 and 10 in the world, and we're 1 and 2 today. And it's really because neither of us did anything that irreparably harmed the franchise.
So you're going to share one
Look, I would say the biggest, when we went to new countries and we bought development where we didn't really understand the local jurisdictions, bad idea. And the people all left when we bought a company, and all of a sudden all the approvals disappeared. Yeah. And we bought in just like we were in the paper business in 30 years ago. And if you have a business that's going down, not many businesses are usually there's a price that you can pay for a business that it's fine. It's all about price. But there are some businesses that are in total decline that actually price doesn't matter. It will go down, and you're never going to get your money back. So we had a few of those, and I would just, in general, we've tried to stick to things we know.
And also going into a market, choosing a partner, maybe leaving some money on the table, but to deal with the local expertise. Well, we've watched you do it. We've gone to school, trying to do the same thing. It's been helpful. I'm going to turn to values. We're in a low interest rate environment, to say the least. Historically, when that happens, what happens is cap rates go down, multiples go up, people invest more. We've got a global investable universe today of $27 trillion looking for alternative assets. There's $17 trillion in fixed instruments that are yielding less than 1%, and some of the overlap with the 17 is the 27, frankly, but it's an insane amount of money. You've got political headwinds or geopolitical headwinds. You've got the fear that we're late in the cycle. So that combination of things begs the question, if you're bringing in $50 billion, you're focused on alternatives, do you still think there's life in the markets to keep going? And more importantly, how does this all end?
So that was like 14 questions, but
yeah, it's really just two.
It
requires some setup.
Yeah, I would say, look, I'll say 4 words that, and we have, I guess we try to have themes around our organization, and I'll just give you context for what I'm going to say in a second. The context is, in 2009, the theme was, whatever money we can possibly scrape together, we should invest, because everything is really cheap, and if we can make it through, we will make a lot of money on that. The real question is, was it going to go down, and did you need the money for something else? So it was a tough, in hindsight, it looks really simple. 2009, you should have bought everything. Stock markets are up by 5 times, whatever that is. I would put it to today, our view of the world is 4 words. Invest, but invest with caution. And I would say that's generally around the world, other than, I'll give you an example that is to the advantage of those that can and have capital to invest globally. India today is under the same conditions that existed in the United States in 2009. it is under a very stressful financial situation. The macroeconomy is fine, GDP is fine, but they have a very difficult banking crisis going on. The non-bank financials are in trouble. Some of the banks are in trouble. Therefore, there's significant opportunity. So whereas I say invest, but invest with caution, that generally means developed markets. It doesn't mean some of these special situations where those that have capital to invest in those places can invest.
But last year, 85% of your roughly $35 billion of invested capital was North America. Is that because it was hard to get it into Asia, India, emerging markets, or was that because you saw legs in this economy, or frankly, feared some of those other economies?
Look, we don't really set targets, and we don't. When we go out and raise a fund, we say generally where we say the money's going to be invested, but it's not set on us to do that. Yeah. And the money goes where it goes, and it just happened that we found a number of unique situations to invest capital into in the last 18 months. We bought Westinghouse Electric out of bankruptcy because a Japanese company tried to build some nuclear plants and destroyed their servicing franchise. So we bought the servicing franchise out of bankruptcy. Well, it's in North America, it's kind of unique. And when we say North America, many of these businesses we bought in those numbers are truly global businesses. Yeah. So it's not, the capital happened to go in North America, but they're very global operations. But the real answer is the deals come from where they come, and they fall where they fall. We try not to have determinations other than there are some places we would only put some amounts of money. Like Brazil, 2.5 years ago, we were investing a lot of money in Brazil. We could have bought everything in the country because everything was on sale for 35 cents on the dollar.
Everything you didn't own in the country already.
Yeah, and we bought a lot more, and we sat down ourselves and limited ourselves back to the rule of never make a mistake that will unduly harm the franchise. We sat down, and while we had no limitations on us, we had our own limitation. We should only have so much in a fund exposed to that because, well, in hindsight, it looks like we were right. Yeah. We could have been wrong. And while we would have made more money for our clients if we would not have put that self-imposed rule on it, the right thing to do was to put it on.
Now you have 100 years plus history in Brazil. You've been through, I don't know how many currency crises, how many overthrown regimes. So that data set clearly helps you make those decisions.
Look, the only thing I'd say about these countries, it's not easy. Like you know that. India, Colombia, Brazil, Peru. We try to pick countries that have a culture of respect to capital. We can operate with the standards we operate with. They're big enough that we can have size, but none of them are easy. And if the only reason we go is the opportunities are there and we earn a greater return than you would in the United States. If you could invest in the same opportunities, you'd pick Canada or the United States. Like, these are the two best countries in the world to invest, other than the fact that there's lots of capital here and the pension funds are always buying everything. Other than that, it's easy. But you would not go to those places if you didn't need to, because it's not easy. This is not simple.
Years ago, I was chair of CBRE in Latin America, residing here in Canada, and we had a big operation in Brazil, and the real went from $1 to 30 cents in 4 weeks. And we were sitting there going, the U.S. chairman called me and said, "You can't bonus your people." I go, "Oh, yes, I can. I'm bonusing them in cars. Because if I give them money, it's wallpaper, and I got to keep them around. And by the way, in their local currency, the business is up 20%. You just happen to think it's a fraction of last year's business. So you run into these issues." I have an expression, and it's not mine. I stole it from someone years ago, and it is business travels at the speed of trust. One fun story, about 7 or 8 years ago, Bruce called me on a Saturday, and he goes, "I have an opportunity in London. It's a 100-year ground lease. We've tied it up with the City of London, It's about 600,000 square feet, probably 500 million pound development. Not sure if we love it. If you're interested in half, if your team underwrite it, it might give me more comfort that it's good. And by the way, if our team underwrite it simultaneously, it may give you more comfort that it's good. And would you like to do this? And I said, it was a Saturday. I said, sounds good. Any other catches? He goes, yeah, we have to fund Friday. I remember. And he goes, and I go, how are we going to get a shareholders agreement between our two combative teams in London in 5 days? And you said, because I have a joint venture agreement from a deal we did last week with somebody who's not as nice as you. So we can use that as a template. And true enough, we funded Friday, the following Friday. We built the building, had a terrific success. We actually sold it back, our half back to Bruce a week ago. Our internal rate of return, and this is what people don't quite understand, even in London, is about a 17 or 18% during that period of time, because it's not
Compound. Yeah.
Compound. He'll
Just
do
to be
better
clear.
now
Just
that
to
he
be clear.
owns our half.
Just to be clear.
And when we were selling it together, and then he wanted the half, so he knows something I don't know. But by the way, we'll take our 18%. But the truth is, with one phone call, business travels at the speed of trust. And Satish is back here, our CIO. We've got about a $3 billion, it's 2.99, I looked this morning, $1 billion relationship with you and your team. With one phone call, we're in funds with you. We believe in your stock. We believe in your story. Places we can't get to, we back you. You call us when you want to throw off a little bone from time to time. But the phone works, and talk to us about your experience about business traveling at the speed of trust.
You know, the only thing I would say is we in our institutional client relationships, which it's easy to have the ones, not easy to have the ones here. The ones in Canada are maybe the hardest to keep up because we're always competing with each other and we're in the same place. But I think we've come, certainly with you guys, but with most of the institutions in Canada, we've come to a great spot. We have a relationship, we do business beside each other. Sometimes we compete, sometimes we're together. And I think that's a great spot to be, and we're very pleased with that. The one benefit that's really interesting that we never imagined, never thought of it in our wildest ideas, but we manage large sums of money for virtually all sovereign institutional investors in the world. And what that means, on top of just getting money from them, is the relationships that we have with some of these organizations at the very, very senior levels of the country give us access to those countries which very few other people have. And that has become a very special secret sauce we have, which others don't have. Because some people go to the countries and they try to figure out who they're going to partner with. We're actually already partnered with the 3 institutions in XYZ country, and those people know us really well and they trust us with their money. Well, obviously they'll trust us to work with them in their country. Right. So it's a really this has and I think will increasingly become a big business generator for us, if you want to call it, around the world, and that's been a big benefit. But it's all trust, and that in deals, institutional relationships, and everything.
And even companies with their elbows up years ago, and since you've been there, particularly with your platform, that was yesterday's news. You know, it's a small world. Your word means something, and I think if I were to reflect on your story and your success, it's because you're the real deal. Your word means something. Your handshake means something, and it is all about trust, which brings you back to Canada. Without any exaggeration, we've lost the Eatons, we've lost the Bays, we've lost the Hutcheson Bays. We've had Roots and Tim Hortons and Four Seasons get traded to foreign capital. And Brookfield has been a consistent source of Canadian pride for a long time. So does it help you to be a Canadian? Reflect on your origins in Canada. Does anyone care? This is a room full of Canadians, so be careful with your response.
So here's what I'd say. Many of you in this room do work for us, partner with us, give us capital, own our bonds or preferreds or our shares of our companies within your institutions, personal accounts, or otherwise. So firstly, thank you.
You can go home now.
Exactly. That was I want to make sure I delivered that. Here's what I would say is we have an amazing benefit by being from Canada. And the benefit is that we can have I'll call it a softer touch around the world. People like Canadians. American corporations are okay, but we don't get painted with the brush of Wall Street. We don't get painted with the brush of private equity, even though we compete with all the private equity groups in New York. We get painted with a different brush globally, and in the United States, that maybe is looked at one way, but around the world, it's a huge benefit to have a Canadian flag. The second benefit we get is Canada is a very wealthy place with lots of capital, and therefore, being from Canada means that we can source capital here and invest it internationally. So all the money that comes into our partnerships, into our funds from Canada is disproportionate to the rest of the world. And that's a huge benefit we get. So we are tremendously proud of being Canadian. And in fact, the third one, I'm going to give you and your friends in the pension fund industry. Some of you may know this, but we travel to whatever country it is in the world, Korea, Japan, China, Australia, Europe, wherever it is, and they give us credit that we know what we're doing because they want to be like the Canadian pension plans. Yeah. And that being set up in Canada is, firstly, it was an amazing thing done for the country because our pension systems are unlike any others. I don't know if we're fully funded, but we're close to fully funded across the country. That is an amazing accomplishment, and it's only because of good governance and setting up these organizations. The benefit we get, that's great for the country. The benefit we get is you're out there seen as the 6 Canadians, 5, 6, whatever it is, Canadians, big entities, are seen as what everyone else in the world wants to become. There's only 10. There are 10 organizations on the planet that have properly put together fully scaled investment organizations, and 5 are Canadian. Yeah. I'm rounding numbers.
And I'd argue about one of them, but we'll get back. No.
But of those 10, 5 are Canadian. As a result of that, we get enormous benefit drafting off. In fact, some places they think we're a pension plan. So I often, if it suits our purpose, I don't argue with them.
I wish they'd think we were you guys. We would take it. It's interesting. There are really 3 reasons in this country why that is so. And it was made okay through legislation for Canadian pension plans, the bigger ones, to delink from the government so it doesn't get politicized. It has been made okay for us to buy platforms. So in 2001, when OMERS bought Oxford, you combine this real estate expertise with this balance sheet. Can't happen anywhere else in the world. And frankly, you can pay people properly. Not this properly, but properly. And so those...
Hey, I thought we were being friends here.
Yeah, no. It's, anyway, I won't go there. But those are the 3 things. Now, you were kind. When we invested in Hutcheson Yards, one of the first calls, it was about June of 2010, I got a call from Bruce. He owns the neighboring super block. It's only a $8.5 billion project, by the way, beside the Hutcheson Yards one. And you said, congratulations, I think you're going to do well. More importantly, I hope you're going to do well, which is a Canadian thing to do. But your thesis was, if you do well, we do well. If we do well, you do well. We both had an extraordinary run down there. Do you want to reflect on your West site and the success you've had, and any reflections on our collective story on that 26-acre, probably 40 acres between the two of us, corner of the island called Manhattan?
Yeah, so just for everyone's benefit, New York City has moved west and south, and it was really opened up by what they did, along with their junior partner related.
Yeah. If we can get that in quotes, because I can guarantee you Steve Ross wouldn't appreciate it. He's our partner down there.
And what they did to open up this part of the city is incredible. It's probably, is it 25 million square feet in your side of the development?
Ours is 18 to date. It's about 24 billion to date, and there's another 8 to come.
And I would say your investment was gutsy. Ours was, like usual, kind of along the way. We were there 25 years ago. We bought other pieces along the way. In actually 3 recessions over 25 years, we assembled the site. Recession 1 was 1994. Recession 2 was 1999, 2001. Recession 3 was 2008. We bought 3 parts of the site. So we were kind of there, but what you did was redevelop the whole area, and then we just went along behind. And so we'll be completed almost 9 million square feet this year, in the next couple of years, and it's an incredible development. And really, the whole city of New York has moved that way, and I think it will change. It'll change Manhattan for the next 25 years until all the buildings on Park Avenue are ripped down. And now that they're upzoned to 30 times, then people will move back to Midtown.
We got one, Satish. Sounds like we ought to sell it. 450 Park. It's been an incredible run for both of us. And if you haven't walked the High Line, I think you'll be a very proud Canadian when you look at the project we've done and the project they've done. So I have a litany of deals I could ask you about, and I won't because we're short on time. I will ask about Oak Tree Capital. This was a $122 billion asset under management business that Bruce bought last year. Took a lot of people by surprise. Do you keep the name? Do you not keep the name? Why did you buy it? Why did they allow you to buy it? A couple of reflections, and then soon enough we'll open it up to the floor for questions. So start thinking about that.
So some of you may have heard of Oak Tree. It's run by a man by the name of Howard Marks. Howard's probably one of the wisest investment people we've ever come across. What we do is buy private assets and own them ourselves. And what they do is essentially do the exact same thing we do, but they buy liquid securities. So they're normally buying debt. And so they're buying the same, they're doing the underwriting the same we're doing with less perfect information. They're buying bonds at 65 cents on the dollar and hoping they'll go to par and then selling them, and usually not controlling the investments. So this is it's a liquid business. They're doing this, I'd say how I'd characterize it, they do the same thing we do, but they do it in a liquid form. We did it for 2 reasons. One, our clients around the world, as interest rates are down, are looking for more fixed income alternatives, and we think having scale credit on the same discipline that we offer our equity products, having scale credit can be added onto our offering to them. Secondly, and maybe more strategically, the greatest value that can be created in any business is being prepared for the times that get tough in the markets. And we are 11 years into an economic recovery. Their specialty is buying distress. And at some point, I don't know whether that's a year from now, 2 years from now, 3 years from now, or 4 years from now.
That was one of the questions I was asking earlier that you avoided. Is it 1 year, 2 years, 3 years, or 4 years?
Don't know, but I expect it's within the 4.
I do too.
At some point, the markets are going to turn, and this franchise will do really, really well. And our thesis was this gives us another arrow in our quivers when the market turns to give us the confidence to grow and come out. You were referring to 2008. Everyone else went away. It should give us, hopefully, if we do our jobs right with our franchise behind them, they will run it. They're going to do the same thing they do. It's not getting integrated into Brookfield. Okay. They're going to run it, and they kept their shares. So we just bought the public out, so we own the 60% the public owned. Yeah. and they kept their 40%. And so we're just partners with the management team at Oaktree. And if we do our job right, it will excel out of the next recession.
I think it's brilliant, and the market reflected it, and it's part of the reason I think your stock is doing what it's doing. We're happy to open it up for questions. Sorry, one over here, and your second.
I think you mentioned initially what will be the future of private investments, and I just wanted to get Bruce's comments around how do you view the valuation going on. I mean, it seemed like it's tough to the valuations have been going high and high, and with the low interest rate environments, a lot of capital around chasing the same assets. So, what do you think about the future of private investments going forward?
So I'm going to give you a controversial answer because I know most won't expect this answer. But because the common thing is, and maybe this is actually what's going to happen, but the common thing would say is we're 10 years into a recession and the world's going to blow up, and at some point in time, therefore, valuations are really high today. Look, the contrary comment on that is that interest rates are zero in Japan, they're negative in Europe. There's an enormous amount of money out there. The greatest spread ever in history is right now between real asset investments and businesses that generate cash and the treasury bond, which means that only two things can happen. Interest rates are going up or valuations are going up. And we see no reason why interest rates globally are going to go up. And therefore, what that may mean is that valuations of businesses and infrastructure and real assets are actually going up more. And it's possible that's what's going to happen in the next while. Do you have a different view?
No, I think your defense is quality. If you buy great assets with $25 trillion out there, I wouldn't say it's a greater fool theory, but you can insulate yourself often by buying high quality. And there are lots of infrastructure assets, lots of PE assets, lots of real estate assets where you're getting significant year-over-year increases in revenue, call it by way of rent increases or concessions or other things depending on the asset class. So you have to focus on quality and you have to focus on incremental revenue sources against which you gain incremental value. Those would be my...
How much of OMERS is alternatives today, the way you define it?
So we're
is it
with
close to half?
infrastructure. Yeah, it's a little over half.
Oh.
We just passed asset liability. We didn't actually. We put it through our investment committee. We approve it at our board next week. So maybe I'm leading the witness here to a couple of board members. We would go as high as 60 if we could. Now, as a pension plan, we were an outlier. We were way ahead of the curve in terms of getting into privates, and everybody's playing catch up. But we would be very comfortable at 55 or 60. Today we're approximately 50, and we've all got fixed instruments burning a hole in our pocket. So for great assets, we're going to find a way. But I do think there is opportunity also. There is still a way, and with great teams looking for great quality, looking for growth instruments, that's your insulation against what this inevitable correction may be. Danny.
Bruce and Blake for such an insightful and informative discussion. And my question really comes back, and it's for both of you, but playing off of your motto in current times, Bruce, invest with caution, is how are you accounting for some of this mood around the world of political turmoil, populism, things that seem to go kind of even above market analysis, even looking at very specific kind of government policy and rule of law in the current environment, but this kind of overall trend may be moving away from rule of law and these broader global political risks.
Yeah.
How are you accounting for them? Are you accounting for them?
About the
Any advice?
He's a Tories lawyer, just for information. Yeah.
So look, we could debate politics around the world all afternoon, but I will try to simplify my overall, or our overall opinion in the following statement. If you find, in what we do, as opposed to many other businesses do something else, we buy infrastructure or backbone assets of the country or real estate in countries. We run the business, and trade doesn't really bother us. What we need is a culture of respect to capital, a rule of law, and the ability to operate with the standards we have and size to be able to do what we do. And if you find good places, and I'll use the UK as an example, it's been 3 years of a total mess. I could say other words, but I shouldn't probably say them. Despite that, business is pretty good. We made a lot of money on that building. We've made a lot of money on other buildings. People are renting space. Business goes on. And eventually we'll sort ourselves out, and the UK is going to be fine. So if you find good countries that have a rule of law, I think you'll be fine. If you go to places which don't have those things, you're going to be in trouble. And that is an age-old story. So I think so we try not to, like I would just say, we try not to read the headlines.
Same with us.
What's important of having people in a country, the largest trade that hedge funds in the US put on Canada is the housing market's going to collapse. That's the largest trade on, maybe it's not on now, but it's always on. I'm looking at the CIBC guys here. I'm sure you get calls every day. And it's based off of a false premise. It's based on, look, the mortgages are recourse to people. The banking system is, there's all the reasons why. And it's just because people, they read the headline, they don't understand the facts. And so you have to have real facts.
I'll just add to that. 100% agree. You cannot speculate on political outcomes. You have to see through cycles. You have to buy assets through the cycle. If you understand, I'll take real estate again as an example. In London, the UK has been in the penalty box. Greater UK has been in the penalty box. Outskirts of London have been in the penalty box. There are 2 city blocks that we've invested in the West End and in the City of London, where the real estate fundamentals are terrific. And when it's in the penalty box, London, it's still one of the 10 most investable cities in the world if you understand the 2 city blocks that make sense for you. So you can find ways to outpace the headlines, and you cannot sit there. And if there are 200 countries in the world, there may be 100 to the rule of law question where we just won't go. He's more of a pioneer. If he doesn't makes it, we'll follow in a few years. But to the countries we focus on, you can find a way, and the last thing you want to do is start worrying about next Thursday's election and thinking that means your investments are going to turn on a dime in London. I think we're out of time. I want to respect your time. I just want to leave the last word to our guest of honor today. Not too many people have been in one organization for 30 years. Not too many people have led an organization for 17 years of unmitigated success. We all like to leave the campsite better than the way we found it. You have had an amazing chapter to date. I asked Jack Cockwell how long you're going to be at the helm. He said approximately 80. But what does the next chapter look like for you? What does your dream look like for Brookfield? And the last word is yours.
So I've learned in life to be short when somebody says that. Look, I just go back to what I said earlier. Our goal is to make the organization a great institution and have it survive over long periods of time. So we need to plan succession well in all of our businesses and continuously do that. And hopefully the people that we pick, my group of partners lived up to what Jack said, and hopefully the next ones we pick will live up to what we chose for them. And I think if we can do that, then that's great success.
Good, humble, and totally appropriate answer. Big round of applause for Bruce. Thank you, my friend. Great job.
Great. Paul Farrell from CIBC to thank Bruce and Blake properly.
Oh, these are good notes. Okay, this is the last word for the event. So, Blake, Bruce, I had to think about that. Thank you for a great discussion. I mean, we're all, and what occurred to me when I looked around the room and everyone was talking is that we're all friends, and we do business together like Canadians to help great companies like yourself prosper. And so I think the unique thing that we have in Canada that I don't think we'll ever lose is the friendship that we have to make these great Canadian companies global successes. So on behalf of CIBC, Blake, we did sneak enough profit. We don't make as much as Bruce, but we sponsored the event, so that's good. So on behalf of CIBC, and frankly, all of your friends here in the room, because we all are friends, continued success, and thank you both very much.
Let me just say quickly in closing, on December 12th, we have Stephen Poloz, the Governor of the Bank of Canada, coming, and on December 13th, we have the inaugural Nation Builder of the Year Award for the Toronto Raptors featuring Masai Ujiri. Thank you very much, everybody. This meeting is adjourned.